Well, happy to have the chance to present this. So motivation, I think this will be not really needed for this crowd. Companies are coming under increasing pressure from stakeholders to pursue environmental and social goals. And we have some evidence of that in the paper. While this has been happening, a growing academic literature and a previous paper with Luigi is one example of that, has argued that the usual presumption in much of finance and economics that firms should maximize profit or market value is no longer valid in a world where, as a result of political failures, externalities are not well controlled. And when that is the case, shareholders may wish firms to pursue social goals at the expense of profit, and consumers and workers may also be willing to pay a price for firms to act in a socially responsible way. What we ask in this paper is, how can these various stakeholders bring about corporate change in practice? And we argue they face two choices, using here the terminology of Hirschman: exit or voice. So exit refers to divesting from polluting or dirty companies. I'm going to use the terms dirty and clean a lot in the talk. That's for shareholders can do that. They can divest. Consumers can can boycott by refusing to buy the products of dirty firms. Workers can refuse to work for dirty firms. The only reason that's in parentheses is because we don't have that in the model. We don't have workers, but I don't think we argue in the paper it wouldn't be very different. They wouldn't be very different from consumers in terms of the mechanics of the model if we put them in. So these are exit strategies. Voice refers to engaging with management, for example, by voting. So that's something shareholders can do because they have the votes. The other groups are going to be not be able to use what we call voice in this paper. That's is exclusive to shareholders. So we're interested in which strategy is more effective. And to give you a preview of the main findings, we will argue, this is a theory paper, but we'll argue based on theory that exit is less effective than is often thought, and the private and social incentives to exit are not well aligned. In contrast, voice is more effective than is often thought, and under some reasonable assumptions, private and social incentives are aligned. Now, there's a very large literature on these topics, and we have, we talk about some of it in the paper. So I refer you to the paper for that. Let me just highlight two papers. The model of our paper is closest to a paper by Henkel, Krauss, and Zechner from 2001. And there's also a recent paper by Pastor et al. The differences are we endogenize the divestment boycotting decision. Actually, those papers just have divestment. They don't have boycotting. They don't have voice. But also, one of the things we're doing is we not only look at the consequences of divestment, but we ask whether people have an incentive to divest or to boycott. The other thing which is a difference from at least some of that, the previous literature, is our agents are consequentialists. So in the model, there isn't going to be a taste for clean firms, for investing in them or buying their product, or a distaste for investing in dirty firms. It's rather that people are going to divest or boycott in order to have an impact. And you'll see how that plays out. And I don't want to claim everyone is exiting for the reasons in the paper, but I think it is interesting to ask whether exit makes sense if you want to have an impact versus, let's say, voice. Now, in the model, if everyone was self-interested, they would not engage in social action. So in order to expand social action, either exit or voice. To explain these things, we assume that some agents are socially responsible in the sense that when they make a decision, they put a positive weight, lambda, on the well-being of others affected by the decision. So this is also something we assumed in Luigi and I in our 2017 paper. So just to give you a flavor of this, let's take a only too topical example of people wearing a mask. So imagine you're deciding, let's suppose it's not a law that you have to wear a mask in a certain setting, but you're just making a private decision whether to do it. Let's suppose it causes you disutility of 10, okay, to wear a mask, but it confers a benefit of 50 on the people you are going to be interacting with. So according to our model, the way you would make the decision is you would say, okay, minus 10 plus 50 lambda. So you put weight lambda on the 50. This lambda is a parameter between 0 and 1, and it's peculiar to you. And so if your lambda is bigger than a fifth, you will wear the mask, and if it's less than a fifth, you won't. So that's the way things are going to work in the model, as you will see. Okay, so let me now jump into the details. And I hope there aren't too many of them, but I think it's one of the, this is it's a paper with, I hope, with ideas, but it also is, has some technicalities, and I do want to give you a sense of what they are. So it's a 3-date economy. Firms are set up at date 0. Production decisions are made at date 1. And at date 2, a good is traded. So that's when production actually occurs and consumers buy the product. And any uncertainty is also resolved there. There are 3 distinct groups in the model. There are entrepreneurs, investors, and consumers. Entrepreneurs are the people who set up firms at date 0. They care only about money, and they have 0 wealth. There's going to be an externality, which we can think of as pollution at date 1, or climate change or something, carbon emissions. Now, this is the model I'm going to talk about today is not a rational expectations model. We have an extension to rational expectations in the paper, but we're going to take the view that when firms are set up, people do not anticipate climate change. Okay, at date 1, they learn about it. It's an unpleasant surprise that we're causing problems to the environment, but people don't know about it at date 0. Okay. We're going to study a competitive free entry equilibrium for this economy. Okay, let me give you a little more information about how things work. Firms are set up at date 0. There's a setup cost F for each firm. And then there's a 0 marginal cost for that firm up to a capacity constraint of 1. Okay. Now, there's also a further fixed cost of production, which it is incurred at date 2. So, the fixed cost F is incurred at date 0, but then over at date 2, there's some other cost, which has an expected value of 0, but is noisy. It's random. The cost is random. We write C equals epsilon, where epsilon is an aggregate shock. Okay, it's the same for all firms, and it's normally distributed. So it has mean 0 and variance sigma squared. And you only learn what this cost is after you've made your production decisions at date 2. Now, the reason for this is when we come to investors holding shares, we want something to limit how much investment they want to make. They're going to be risk averse. If this was a purely idiosyncratic shock, they could just diversify across firms and get rid of it. But we want their risk attitudes to come into play. So that's why we assume it's an aggregate shock. Now, there could be an idiosyncratic component as well. Indeed, you should probably think there is, because at some point I'm going to want to suppose that investors do diversify across firms to get rid of at least, let's say, the idiosyncratic component. Okay, now the basic economy has one consumer, one investor, and many potential entrepreneurs. Now, this is, of course, not at all competitive. We were interested in a competitive free entry equilibrium. So we're going to eventually replicate the economy. So we're just going to, in the replica economy, will be our consumers and our investors, and still many potential entrepreneurs. That doesn't change. So although I'll be introducing initially the one consumer, one investor economy, you should have in mind that I'm eventually going to be thinking about this replica economy. And in that replica economy, perfect competition makes sense when R is large. Okay, so in a competitive equilibrium, remember some firms are set up at date 0, and at date 1 they make their production decisions, and they're facing 0 expected costs up to their capacity constraint of 1 once they've been set up. So they will, in a competitive situation, they will always operate at full capacity, right? Because they have 0 marginal costs up to, right? So they'll just, each one will produce 1 unit, will sell it at date 2. So the supply curve will be perfectly inelastic. If n firms are set up, capital N firms at date 0, then n units of output will be dumped on the market at date 2. Now, what about the demand side? Let's remember that there are 3 groups: entrepreneurs, investors, consumers. So let's talk about consumers. Right now, we just have one consumer in the basic economy, and the consumer has a quadratic utility function and also constant marginal utility of money. So we have rho q minus a half tau q squared plus m, whatever money she was born with, minus pq, that's the amount of money she spends on the product. Okay, so that's going to be her final utility, and that yields a linear demand curve. Just maximize with respect to q, you get p equals rho minus tau q, and we know from what I just said that q is n. In equilibrium, supply is n, so the equilibrium price at date 2 will just be rho minus tau n. One consumer, n firms. And the profit of each firm sells 1 unit, and therefore at price p, and so the profit is pi, but then we have to subtract this additional cost epsilon, the random variable with mean 0, variance sigma squared. So final profit is a random variable, which is given by p minus epsilon, which is rho minus p is rho minus tau n, so we get rho minus tau n minus epsilon, and the expected value of that is, of course, just rho minus tau n. Now we go back to date 0 and consider the stock market at date 0, the capital market, because the entrepreneurs who are setting up firms have to raise F euros to do it. Okay, and they don't have any money of their own. So the way they're going to raise the F euros is by issuing shares to investors, or to this one investor right now in the basic economy. Now, the investor has, I'm going to assume, a constant absolute risk aversion. So that means an exponential utility function where omega is her final wealth. I'm going to normalize so that her initial wealth is 0. And I'm going to assume that the alternative to buying shares is to borrow or lend at a 0 interest rate. So there's also a riskless bond hanging around also, and you can borrow or lend. Now, in a free entry equilibrium, the market value of each firm must be F, because if V was bigger than F, there would be further entry. Entrepreneurs could make money by selling the shares for V, and then they only need F to finance the setup costs, and they make a profit V minus F. And if V is less than F, they would of course exit. They wouldn't be able to finance the firm. So in equilibrium, V must equal F. Now let's look at the investor's portfolio decision. Suppose the investor buys X firms. So think of, X equals 1 means that this investor is going to hold 100% of one firm. X equals 2, 100% of two firms. X equals 0.1 means he's buying 10% of one firm. Okay, so you multiply X by the profit at date 2, which will be paid out to the investor, which is a random variable. And in order to finance this purchase, remember the value of each firm is F, so it costs you XF to do it. So what the investor would have to do is to borrow XF and then buy X firms. And so that's what her return will be. And this has with constant absolute risk aversion, this has a certainty equivalent, which is given by its mean, X times pi minus F, minus half gamma times the variance, and the variance of this is X times the variance, X squared times the variance of pi tilde. And remember, pi tilde just had this minus epsilon in it, so that's the variance of epsilon, which is sigma squared. So we get this second term referring to the risky part. Now, so the investor will just maximize this with respect to X, right? And the first order conditions give us then the investor's demand for shares or for number of firms. X is just pi minus F over gamma sigma squared. And the intuition there is the numerator is the expected net return of buying shares. And the denominator, you have to deflate it by a term representing, how much you dislike the risk, which is your coefficient of risk aversion times the variance. So that will give you demand. Now, let's think of then market clearing, the stock market at date 0. Demand is pi minus F over gamma sigma squared. And supply is N, because N firms set up. So that's the amount of shares being dumped on the market. This is the demand, so they have to be equal. And remember, pi is rho minus tau N. So we just get an equation with N in it, and we can solve it. And this is the free entry, the competitive free entry condition. That's the number of firms that will set up at date 0. Let me just pause to see whether anybody wants to raise any questions at this stage. Otherwise, I will just go on and say, as I have already said, I want you now to think of the replica economy, where we have, 1 million investors like this and 1 million consumers like that. And it's easy to see that N just gets multiplied by R. That's the number of firms just grows in proportion to the number of investors and consumers. But that economy will be approximately perfectly competitive for large R. And I also want you to suppose that investors diversify their portfolio. So in the basic economy, we have one investor, there's only one, holding in equilibrium N firms. She's buying them all. In the replica economy, we have R investors and NR firms, and I want to assume that each investor purchases 1 over R of each firm, which means they're still holding N altogether effectively, but they are spreading their investment equally among them all. Okay, now this is what happens at day 0. We now arrive at date 1, and we learn the shocking news that climate change is with us. So the way we model that is we suppose that each firm that's set up at date 0, if it operates with the existing technology, will produce harm, H positive, some positive harm. And I'm going to assume this is spread equally over all the investors and consumers. Somehow the entrepreneurs are not part of this story anymore. They've left the economy. And so each investor and consumer experiences H over 2R of harm. Okay, multiply that by 2R and you get H. Now, a firm can avoid this harm by incurring an additional fixed cost, delta at date 1. And a firm that decides to do this, we call clean. So I start with the first best. Suppose a planner, a benevolent planner, took over this economy. What would they do at date 1? Well, the number of firms is historically given. They can't do anything about that, the ones that set up at date 0. All they can do now is decide what fraction of them should become clean. One point which is useful for the future, when the planner decides, to convert some of them to clean, it doesn't affect the date 2 output market, because clean or dirty, you still will, have your capacity constraint of 1. So each firm will dump 1 unit of output on the market. And so the product market equilibrium at day 2 will be unaffected by this choice. Now, it turns out, the details in the paper are in the paper, but you can show that the planner solution is bang, bang. If H is bigger than delta, she will want all the firms to become clean. And if H is less than delta, she'll want them all to stay dirty. And the intuition here is very simple. You just think about it. You're the planner. If you make a firm become clean, you're incurring a cost delta for society, but you're saving H. Everything's measured in money. So it's a simple choice between delta and H. And that's why you get this very simple solution. Now, I want to assume there's a government failure. The planner is out to lunch, and it's a long lunch. And so we have to instead consider private actions. And let's start off with divestment. So what we do in the paper is we consider 3 possible actions: divestment, boycott, voice. And we do them separately, okay, one at a time. So let's start off with divestment. So investors, our investors, some of them are now think, well, maybe I can get firms to become clean by divesting. So these investors, some of them are socially responsible. You can imagine they have different lambdas. Some of them may be purely selfish and have a lambda equal to 0. Let's assume that a fraction mu of investors announce at date 1 that they will hold only shares in clean firms. So the exact timing is they sort of go on social media, okay, and they make an announcement, and we assume that it's credible, that they can commit to this, which is a strong assumption, but it's giving Exit its best shot. And we discuss what happens if there isn't commitment in the paper, but for the presentation, let's assume they can commit. So some fraction of investors announce that they're going to do that, and firms look around, see the social media postings, and realize that quite a lot of people, let's say, are not going to buy their shares unless they become clean. Okay, so we're going to look at the consequences of this, and then we're going to ask whether these investors actually want to stick to this strategy. In other words, is it a Nash equilibrium for a fraction mu of investors to divest? Now, the mechanism, how does divestment work? We suppose that firms are run by value maximizing managers. So they were set up by the founders, by the entrepreneurs at date 0, and the entrepreneurs installed managers and put them on some sort of incentive scheme. We discuss why in the paper, but let's just assume that they are interested in maximizing value at date 1. So when they find out that people are going to divest, what they realize is, well, if I stay dirty, the market for my shares is smaller because people will be selling my shares. The divestors will be selling my shares, driving down the market value of my firm. I don't like that. And maybe as a value maximizer, what I should do is become clean. It's costly, but if I do that, I suddenly find more people are willing to buy my shares. And so I might actually end up with a higher market value. In equilibrium, again, the date 2 product market equilibrium is unaffected by all this because we always have a perfectly inelastic supply N at date 2. In an interior equilibrium where both clean and dirty firms operate at date 1, in other words, some firms have chosen to become clean, some have decided to remain dirty, they must have the same market value, because otherwise these value maximizing managers would continue to switch. So, okay, so let me just show you quickly how we compute the equilibrium. For divestors, their demand is given by, it looks like the formula we had before. Remember, on the numerator, expected net return. Well, that's now pi, the profit, the expected profit at date 2, which is as before, rho minus tau n, minus the additional kick. Okay, so this is the demand for clean firms. Clean firms incur an additional fixed cost and cost V. So that's the net return. And then you have to deflate it by gamma sigma squared. So that will be their demand for clean firms. We multiply that by the fraction of people who are divesting, and then that must equal in equilibrium the number of clean firms. For dirty firms, it's ND is the number that supply must equal 1 minus mu, the fraction of people buying dirty shares. And for them, it's the same thing, except we don't have a minus delta, because those firms don't have to incur this additional cost. So if you add those two, and you remember NC plus ND must equal capital N, which is predetermined, and you use the information we have about N, which I was on the previous slide, and you fiddle around a bit, you get a formula for NC. This is the number of firms that will set up, that will switch to clean in the interior equilibrium when a fraction mu of investors divest. And it's a quadratic, okay? And this is similar to what you find in the Henkel et al. Paper, so I don't want to dwell on that because I want to get to the bits which are new. But I just want to note that we can have a corner solution. So if this thing is negative, that just means that actually there won't be an interior equilibrium and no firms will become clean. And that's quite possible. But I want to, again, giving exit the best shot, I want to assume that we do have an interior solution, and that will be the case if big N is bigger than delta over gamma sigma squared. You can just check that NC is positive in that case. All right, now I want to go back and ask whether people will want to divest. Okay, so let me give you the sense of this, perhaps without going through all the details. So you were one of this fraction mu, but now you're thinking to yourself, do I want to be? Would I prefer actually not to go on social media and say I'm going to divest? By agreeing to divest, by committing to divest, you give up some return, because as a divestor, your return is given by this. Let's not worry about X naught is your holdings from date 0. But the main thing is look at the first term. There's a minus delta in it. Whereas as a non-divestor, there's no minus delta. In other words, in words, divest, because in the interior equilibrium, the two firms are selling for the same, right? Their shares have the same price, but one of them is yielding a lower profit at date 2 because of it has this extra cost of becoming clean, and the other one doesn't. So obviously, other things equal, you prefer to buy the more profitable one. Sells at the same price, it's delivering more. But you are not a divestor, so you've said you're not going to do that. So obviously, you're going to be worse off, right? And we can compute the certainty equivalence and take the difference, and we get a formula for how much worse off you are. Now, that's only one part of your calculation, though, because you're socially responsible. So what you do is you say, okay, I'm going to lose something by divesting, but what's going to be the gain for society? And I'm going to multiply that by lambda and decide whether it's all worth it. So the if gain for society, there are 3 components. There's the impact on the environment, because if I divest, that's going to drive down the market value of dirty firms a little bit, and that's going to cause more firms to become clean, and that will lead to a cleaner environment. But I also care about my fellow people in terms of, how well they're doing on their in terms of their investments and consumption. So I care about the impact on other investors and the impact on consumers. Well, we can deal with those very quickly, starting from the end. The impact on consumers is zero because remember, the product market at date 2 is unaffected by the clean dirty choice. So there'll be no impact on prices or on consumer welfare. Other investors are all optimizing, and so a small change in the market value of firms because of my divestment has a second order effect on them. This is the famous envelope theorem. And so that's it. So we're left with the impact on the environment. Now here we have to be quite careful, and let me just give you a sense of it. We have to keep track of the fact we're in the replica economy. So basically what we do is the following. We say, look, currently mu-R investors are divesting, and there are NCR clean firms. And if I stop divesting, mu-R becomes mu-R minus 1. And therefore, the fraction becomes mu-R minus 1 divided by R, which is mu minus 1 over R. So I change mu by 1 over R when I divest. The change in the number of clean firms, well, we have a formula for NC as a function of mu, and we're actually interested in RNC. So we're interested in how RNC changes, and that is just going to be R times dNC by d mu times delta mu, plus second order terms, which will converge to zero as R tends to infinity. And notice that delta mu is minus 1 over R, so that cancels with this R. And so you end up looking at dNC by d mu, and here's the formula for NC, and you can differentiate that. And what you find is that the effect on the environment, this is the change in the number of firms, clean firms, or times H, because every time you have an additional clean firm, you save H dollars in terms of climate problems. And so at the end of it all, what we do is we go back, we look at the personal loss from divesting, and we compare that to the environmental gain from slightly more clean firms multiplied by your lambda. And this is the inequality, which ensures if that inequality holds, you will be happy to be one of the divestors. But if it fails to hold, then the personal loss is too big and you will stop divesting. So to be in Nash equilibrium, that has to hold. And if you rearrange that, you get this. So it's not, child's play, this formula. And in fact, that's one of the implications, the conclusions I want to draw, that if you look at this hard enough, and you start to ask yourself, well, how big is lambda in reality? Well, there are some experiments actually on lambda. We mentioned them in the paper, which suggest that lambda about a quarter is not unreasonable. Remember in my mask example, it all depended on whether lambda was bigger than a fifth or a quarter. Well, sorry, a fifth or less than a fifth. Well, let's go with lambda being about a quarter. Now, if that's true, then if pollution is inefficient in the sense that H is less than delta, but not very inefficient in the sense that H is less than 2 delta, sorry, did I say H? H is bigger than delta. Yes, H bigger than delta, pollution inefficient. That's crucial. I think I said it the wrong way. But H less than 2 delta, so between delta and 2 delta, then 2 lambda H will be less than delta because lambda is about a quarter. And so if you look at this inequality here, the second term will be negative because 2 lambda H is less than delta. And obviously, if 2 lambda H is less than delta, then lambda H is less than delta. So the first term's negative. So the whole thing's negative. And so it can't possibly be bigger than the right-hand side, which is positive. So what that means is that our investor will not divest. She will say to herself, it's not worth it. And so we find that the only equilibrium is with nobody divesting, given that their social responsibility parameter is about a quarter. Now, if we slightly embellish the model and suppose that Some people divest for non-instrumental reasons. So maybe some people are divesting because they just find it repugnant to hold shares in dirty firms. And I think there are certainly people like that around. So you could imagine there's some people are going to do it even if it doesn't have an effect. So let's call them mu bar, fraction mu bar. Then this same argument shows that nobody else will do it. They'll be the only ones. The consequentialists, the people who are trying to have an impact, will not bother. Now, okay, I think I'm going to, time is an issue. So let me just quickly, I just want to let me highlight the fact that you can actually get cases of over divestment. So the main conclusion so far is that people may just throw up their hands and say it's not worth it. But if their lambda is higher, you can actually get cases, see the paper, where H is less than delta. So a planner would not want any firms to become clean. It's not worth it. And yet people may actually choose to divest and turn some firms clean. So the more general point is that private and social incentives do not align. Now, with boycotting now, so the second part of the paper, we forget about divestment, and we now allow consumers to boycott. And because time is very short, let me not go into that, except to say that the results are remarkably similar. So if 2 lambda H is less than delta, you can show that no consequentialists will boycott. So again, you may have some people who do it because they think a dirty product is repugnant, but the sort of impact people won't bother. Now, in the remaining time, I just want to explain engagement. Now, fortunately, this requires no math. I can just do it in words. So, okay, how do we think of engagement? First point is it's not obvious because, in fact, whereas divesting and boycotting are fairly institution-free, engagement is not. So it depends on the institutional legal structure to what extent people engage and how. But what we do is we look at a very simple case where the shareholders at date 1, they all wake up to the fact that climate change is a problem, and then there's a vote on a particular firm as to whether it should become clean or dirty. So it's just done by a vote of the existing shareholders. And remember, by assumption, these shareholders are very diversified when they reach date 1 because they were very diversified at date 0. They each bought 1 over R of each of the NR firms. So if we take a particular firm, they're going to be R shareholders, each holding 1 over R. Okay, so think of yourself as one of those. How are you going to vote? It's an up-down vote, clean or dirty. Should our firm incur the extra cost delta or not? So you have a lambda. So the way you think about it is you look at the effect on yourself and you look at the effect on everybody else. And you weight the latter by lambda and you weight the effect on yourself by 1. Now, it turns out the effect on yourself is negligible. Why? Because if this firm becomes clean, its market value and its profit and market value will go down by delta. But you hold only 1 over R of the firm. So you're looking at a capital loss of delta over R, which when R is large is negligible. So the own effect is negligible. Now, what about the effect on others? Well, first of all, there's the effect on your fellow investors who hold, almost all of the firm. You hold 1 over R, they hold 1 minus 1 over R of this firm. And so they're going to incur a capital loss of delta, basically, as R tends to infinity. It's going to fall on them in aggregate, negligible part on you, the bulk of it on them. So that's a minus delta. You care about that. There's no effect on consumers for the same reasons as before. And there's the effect on the environment. If the firm goes clean, the environment improves by H, and you care about that. So there's a minus delta, a plus H, and the whole thing is multiplied by your lambda. So you end up voting clean if lambda times H minus delta is positive, and you vote dirty if it's negative. And notice that gives us a rather striking result, that you will end up acting just the way the benevolent planner did back a few slides ago, where, remember, there was a bang-bang solution. If H is bigger than delta, the planner said go clean, and if H is less than delta, he said stay dirty. And these people will vote in exactly the same way. So private and social incentives are perfectly aligned, and this is true for all lambda positive. As long as you're not purely selfish, you will, for large R, vote the right way. So you don't need much social responsibility. As long as the majority of people have, of the shareholders, have a lambda which is, banded away from zero, you're going to find they will vote in the socially optimal way. In contrast to the exit strategies where, we saw there wasn't alignment, and that in many cases people wouldn't bother to pursue the strategy at all. So, okay, I'm just going to conclude. Let me, with a couple of remarks, so just one more minute or so. The first thing is, it seems to make sense to encourage voting. Voting voice seems to be a good thing here. Second thing is dispersed ownership is playing a very important role here. If we had large owners, the personal capital loss would loom much larger, and they might not vote in the nice way we have here. Okay, we have a bit of a discussion about how mutual funds could actually be helpful and actually paying for the costs of getting things on the ballot, but time is short. So let me just say two other things. First, we've taken preferences, social preferences, as given. Okay, our conclusion that exit doesn't work very well has to be modified if people undertake a campaign which either informs people or changes their preferences. So we give two examples here. The famous boycott of buses in Montgomery, Alabama in 1955 by Black Americans highlighted the issue, made the issue salient of racism in the South to many Americans. Should have been apparent before, but maybe it wasn't. And the Fur Free campaign by the Humane Society, where people are discouraged from wearing fur coats, say, I might not really care about that, but I don't want to go out wearing my fur coat and have people shout at me or hiss at me or throw things at me. So I end up behaving like someone who has different preferences. So these are examples where campaigns can change people's preferences and make exit more powerful and in the model. Voice can also be easily restricted. There's some cases where voice can't be used. Facebook, Mark Zuckerberg has a controlling stake. The Coke industries, it's private, so voice doesn't work there. So exit may be the only alternative. Let me end by just saying that, however, I do think an important conclusion of this is that voice needs to be taken seriously. And it's unfortunate that certainly in the United States, it's very much discouraged. The Securities and Exchange Commission, SEC, has regulations which make voice difficult. It's hard to get things on the ballot. And also, even if a majority of shareholders pass some ESG proposal, it isn't binding on the board of directors. This is a regulation. The SEC sees shareholder proposals as a nuisance, whereas this is saying actually they may be very good ways of pushing companies to act socially responsibly. And final thing, recent Department of Labor proposal, hasn't been implemented yet, but it's being seriously considered, which says that trustees of private pension funds will not be allowed to take any ESG factors into account in determining investments or voting on things. So they have to only look at rate of return. And they're not allowed to consult the people who put the money with them, the pensioners, who might actually want them to do something else. But if this proposal is accepted, they wouldn't be allowed to do that, which seems to be, in my opinion, crazy.
So my takeaway was that the less you hold, the more likely you are to vote clean. But I was wondering, because the less you hold, the relatively higher are your costs for voting, because you have to research everything when you can submit your vote, and doesn't this like level out your cost? And even if your decision would be clean, like it would be like the same cost or even like a higher cost to like vote in the first place?
Right. Well, that's a good question. Let me first of all say, I just want to slightly qualify something you said. The less you hold, the more likely you are going to vote in the socially responsible way. Because if H is, it's not that you'll necessarily vote clean. If H is less than delta, you will vote dirty. It's only if H is bigger than delta that you will vote clean. You vote the way the planner would do things. Now, but your main point, that's minor. Your main point is an important one, which is that if you have a very small shareholding, yes, why would you bother to learn anything about this? That's very important, in fact. I think our answer to that would be that we think in practice, the way this could work is that there would be mutual funds that would set up with a plan about how they're going to engage with management. So that it would be sort of a manifesto. And in this simple economy, they would say, we're going to be pushing firms to become clean if that's the right thing to do, and not if it's the wrong thing to do, but that's what we're all about. And then investors will decide whether to place their shares with this mutual fund or invest in this mutual fund, in other words. And once you've done that, you will have delegated this to the mutual fund, learning about the company. So there are undoubtedly some costs of doing all this, including the costs of putting things on the ballot, if that's, and individuals may not want to do that, but somebody like a Vanguard or State Street or BlackRock will accumulate enough shares and can incur these costs. And then you can sort of just leave it to them. I think that's the way we would think this could work. They're not, they become a large shareholder, but they're not, that doesn't mean they will act as if they own a lot of the stuff, because they've said they're acting on behalf of small shareholders, so they will be motivated to vote the way an informed small shareholder would. So that's the way you can sort of solve, I think, the problem you're talking about.
I was wondering what would happen if the costs in your model, so the environmental externalities essentially, were to be stochastic. Because in reality, we don't really know what the emissions are. Assuming we know what the emissions are, we don't know what the consequences for climate is, right? And given that, what would happen if some investor would sort of overestimate these damages and other would underestimate these damages?
Yes, that's also a good question. I mean, I think the honest answer is I don't have much to say about that. I mean, it's obviously important in reality. Uncertainty per se, isn't the, you can take expected values and so on. But I think maybe you're talking about the case where people disagree. There's always a question of whether they learn from each other or, whether they converge to similar attitudes or whether they don't. We know now, again, if you have institutional investors undertaking this task, moving away from the idea that their job is to maximize return. I think that's traditionally been the way institutions have thought of things, but I don't think it's right, actually. I don't think they should. And as I have indicated, if you had a Vanguard or Fidelity socially active fund and we put our money with them, then it would be their job to learn more about H. I mean, to the extent that it's possible. I mean, we see, of course, look at what's happening right now with COVID. I mean, there's a lot of disagreement among scientists. I mean, I don't think we know the answer. But, presumably you still have to make some estimates and decide whether, I mean, if H is much bigger than Delta, maybe then you say, okay, we're not sure what H is, but we're pretty confident it's bigger. We may know a lot about Delta, not so much about H, but if there's a big gap between them, we might think it doesn't really matter if we're a bit wrong. It's still worth doing. And in other cases, we would be more cautious. That's going to be true for a planner who had complete control. It's going to be true for an exeter, and it's going to be true for someone exercising voice. So, it makes life messier for everybody, is I think my answer. But it doesn't mean that action is impossible. Indeed, we still have to act.
I very much agree with your conclusion, and I was just wondering, Oliver, to what extent, what is your take on why is the SEC so opposed to sustainable investments and to asking the clients? Because Europe is taking the exact opposite direction now, requiring soon institutional investors to ask about the preference for sustainable investments. So there seems to be two completely opposite trends.
Well, yes. I'm not sure I know the answer to that. I think one of my co-authors, Luigi, is very cynical. I mean, not in his private life, but he thinks that it's all. He probably would have a darker answer than mine, having to do with in who's interested. That the SEC is being captured by somebody, probably management. But let me, I will, he's not here, so I shouldn't really assume you to say that, but I'll give you my own answer, which is sort of a bit more benign, which is that I think a lot of people in this sector, whether they're business people, the CEOs, or the fund managers, or regulators, have bought the line, let's blame Milton Friedman for it, even though it's not just him by any means, but in this famous New York Times article from 1970, where he said, the business is business, corporations should maximize profit and leave social things to individuals and government, right? People have sort of accepted that view. So if that's your view, then proposals by shareholders on ESG sort of matters are a distraction and waste of management time, and so should be discouraged. Now, what Luigi and I argued in our 2017 paper, and we're not the only people to be saying anything like this, but I think perhaps we said it a bit more clearly and strongly than other people had said it. In a world where individuals are socially responsible, they may want companies, and if you can't rely on government, which I think is very plausible these days, to solve the problem, then they may want the companies they own or have relationships with to do the job for them, because the companies have a comparative advantage in cleaning up the environment, say, relative to individuals, as opposed to charity. So Friedman basically said, we don't need companies to give money to charity because individuals can do that. And that's quite correct, I think. Companies do not have a comparative advantage in giving to charity, but they do have a comparative advantage in reducing carbon footprints. So once you think of it that way, so I just don't think the SEC had the right mindset. Once you think of it that way, you realize that these shareholder proposals are not a distraction. They may be actually of first order importance. And because after all, if companies are going to act in a socially responsible way, they shouldn't be doing it based on the views of management. It should be the shareholders own the company. They should be asking the shareholders what they want. So, okay, so that just, I may be crazy. I may be, too optimistic about the importance of ideas, but I just think that they've been looking at it the wrong way. And my hope is that they will start to look at it the right way. And, because the environment is changing, and I am sure that people in this seminar know this at least probably much better than I do. There's so much action going on. People, investors and other groups actually wanting companies to be socially responsible. So I think these things may change.